Welcome to the most important car buying warning you'll watch this year. If you're planning to purchase a vehicle in 2026, there are 10 major car brands currently in such serious financial trouble that buying from them could leave you stranded with a worthless vehicle, no warranty support, and parts that become impossible to find. What you're about to discover will shock you and potentially save you from making a catastrophic purchasing mistake. We're going to expose the car manufacturers that are facing bankruptcy, massive layoffs, dealer network collapses, and market share losses so severe that their long-term survival is genuinely in question. These aren't small, obscure brands. Some of these are household names that have been around for decades, and their collapse will leave millions of owners wondering what happened to their investments. Industry data suggests that at least 3 major automotive brands will either declare bankruptcy, exit specific markets, or merge with competitors by the end of 2027. The warning signs are already visible in their financial reports, sales numbers, and dealer networks. Buyers who ignore these signals and purchase vehicles from collapsing brands will face devastating consequences, including worthless warranties, impossible to find parts, plummeting resale values, and vehicles that become financial anchors rather than transportation assets. Throughout this video, we're going to examine 10 car brands showing the most serious collapse indicators. We'll analyze their sales trends, financial health, dealer network stability, and product lineup problems. We'll look at quality issues driving customers away, electric vehicle transition failures, and market positioning disasters. By the end, you will know exactly which brands to avoid in 2026 and why their collapse is not just possible, but increasingly inevitable. Let's start with number 10 and work our way to the brand in the most serious danger. Number 10. Stellantis brands, Chrysler, Dodge. Starting at number 10, we have the Stellantis portfolio, specifically Chrysler and Dodge, 2 American brands that have been dying slowly for years and are now accelerating toward complete irrelevance. These brands represent textbook examples of corporate neglect and failed product strategy that has left them with almost nothing to sell. Chrysler currently offers exactly one vehicle in its entire lineup, the Pacifica minivan. That's it. A once proud American brand that produced the PT Cruiser, 300 sedan, and Town & Country has been reduced to a single model that sells approximately 40,000 units annually. Industry data suggests that Chrysler's market share has collapsed to just 0.3% of the US market, making it statistically irrelevant. The brand has no SUVs, no sedans, no crossovers, and no clear product roadmap beyond vague promises of electric vehicles that never materialize. Dodge faces a different, but equally serious problem. The brand built its recent identity entirely around high-performance V8 engines in the Challenger and Charger, both of which have been discontinued for 2024. The replacement electric vehicles have faced widespread criticism, delayed launches, and customer rejection. Ownership trends show that Dodge's core customer base wants rumbling V8s, not electric motors, and the brand's attempt to transition has alienated its most loyal buyers without attracting new ones. The Stellantis corporate parent is experiencing its own crisis. The company has seen its stock price collapse by over 40% in recent months. CEO Carlos Tavares resigned abruptly amid mounting failures. U.S. dealers are in open rebellion, with many threatening to sue the company over forced inventory, poor product quality, and lack of support. Long-term studies indicate that Stellantis brands have some of the worst reliability ratings in the industry, with Dodge ranking near the bottom consistently. The dealer network is collapsing. Multiple Chrysler and Dodge dealerships have closed or dropped the brands entirely. Parts availability has become problematic even for current models. Warranty work reimbursement disputes have created situations where dealers refuse to perform warranty repairs because Stellantis doesn't pay them promptly. Buying a Chrysler or Dodge in 2026 means purchasing from brands that may not exist in their current form by 2028. Number 9. Nissan. At number 9, we have Nissan, a brand that has experienced one of the most dramatic collapses in automotive history, falling from a respected Japanese manufacturer to a company now facing potential bankruptcy and desperate merger discussions. The warning signs are everywhere, and they're getting worse rapidly. Nissan's financial situation is dire. The company recently announced plans to cut 9,000 jobs globally and reduce production capacity by 20%. Industry data suggests that Nissan is burning through cash reserves at an alarming rate, with operating profits down over 90% year over year. The brand's credit rating has been downgraded to junk status by multiple agencies, indicating serious default risk. Merger talks with Honda have been confirmed, suggesting Nissan cannot survive independently. Sales have collapsed across most markets. In the United States, Nissan's market share has fallen to approximately 6%, down from over 8% just 5 years ago. The brand relies heavily on fleet sales and subprime financing to move inventory, tactics that generate minimal profit and attract customers with poor credit who default at high rates. Long-term studies indicate that Nissan's average transaction prices are among the lowest in the industry. reflecting weak brand value and desperate discounting. Product quality has deteriorated significantly. Nissan's CVT transmissions have become notorious for failures, with class action lawsuits filed over defects affecting hundreds of thousands of vehicles. The brand consistently ranks in the bottom third of reliability surveys. Ownership trends show that Nissan vehicles depreciate faster than almost any other mainstream brand, with some models losing 60% of their value in just 3 years. The product lineup is outdated and uncompetitive. Many Nissan models are essentially unchanged for 7 to 10 years, making them technologically obsolete compared to competitors. The brand has failed completely in the electric vehicle transition, with the Leaf becoming irrelevant and the Aria failing to gain traction. The dealer network is shrinking, with multiple franchises closing or being consolidated. Buying a Nissan in 2026 means purchasing from a brand that may not exist as an independent company by 2027, leaving warranty coverage and parts availability in serious question. Number 8. Mitsubishi. At number 8, we have Mitsubishi, a brand that has been essentially dead in most markets for years, but continues stumbling forward like a corporate zombie with no clear purpose or viable future. This is a company that has become irrelevant to most car buyers and is only surviving through its connection to the Nissan-Renault alliance, which itself is collapsing. Mitsubishi's US market share has fallen to just 0.7%, making it one of the least relevant brands in America. The company sells fewer than 100,000 vehicles annually in the US market, number so low that maintaining a dealer network and parts infrastructure becomes economically impossible. Industry data suggests that Mitsubishi loses money on every vehicle sold in North America, surviving only through financial support from its alliance partners. The product lineup is embarrassingly outdated. The Mitsubishi Mirage, one of the brand's best-selling models, is based on technology from 2012 and has been repeatedly rated as one of the worst cars you can buy. The Outlander, refreshed recently, has failed to gain meaningful market share despite updates. The Eclipse Cross sells in such low numbers that most buyers have never heard of it. Long-term studies indicate that Mitsubishi has essentially abandoned product development, offering nothing new or competitive. Quality and reliability have deteriorated. While Mitsubishi once had a reputation for durable vehicles, recent models have experienced significant problems. The brand ranks in the bottom half of most reliability surveys. Ownership trends show catastrophic resale values, with Mitsubishi vehicles often depreciating faster than any other brand. A 3-year-old Mitsubishi might retain only 35 to 40% of its original value. The dealer network is dying. Finding Mitsubishi dealers in many regions has become difficult, with many former franchises closing or converting to other brands. Parts availability for older models is becoming problematic. Warranty support remains questionable as the brand's financial situation worsens. Mitsubishi has no electric vehicle strategy, no hybrid offerings beyond the outdated Outlander PHEV, and no indication it can compete in the modern automotive market. Buying a Mitsubishi in 2026 means purchasing from what is essentially a dead brand walking. Number 7, Volkswagen. At number 7, we have Volkswagen, and this entry will shock many people because VW has been a major global player for decades. However, the brand is currently experiencing a crisis so severe that it's closing factories in Germany for the first time in its history and facing an uncertain future that should concern any potential buyer. Volkswagen's financial problems are mounting rapidly. The company has announced plans to close multiple German factories and cut tens of thousands of jobs, unprecedented actions that signal deep structural problems. Industry data suggests that VW's profit margins have collapsed due to failed electric vehicle investments, massive spending on software development that hasn't delivered results, and inability to compete with Chinese manufacturers in the crucial Chinese market where VW sales have fallen dramatically. The electric vehicle transition has become a disaster for Volkswagen. The company invested tens of billions of dollars in the ID series of electric vehicles, but these models have failed to achieve meaningful market penetration. The ID.4 has been plagued by software problems, reliability issues, and customer complaints. Sales numbers are far below targets, leaving VW with expensive production capacity that sits idle. Long-term studies indicate that VW's EV technology lags behind competitors, particularly Chinese brands, by 2 to 3 years. In the United States, Volkswagen's market share has fallen to approximately 2%, down from over 4% a decade ago. The brand has become irrelevant to most American buyers. The dealer network is shrinking, with many franchises struggling financially or closing entirely. Ownership trends show that VW reliability remains problematic, with the brand consistently ranking below average in quality surveys. The diesel emissions scandal continues to haunt the company. The financial and reputational damage from Dieselgate has never been fully recovered. trust in the VW brand remains damaged, particularly among American consumers who feel deceived by the company's actions. Parts costs for VW vehicles remain high, and labor rates at VW dealers often match luxury brands despite VW being a mainstream manufacturer. Buying a Volkswagen in 2026 means purchasing from a company in severe crisis mode, cutting jobs and factories, struggling with EV transition, and facing an uncertain future. Number 6. Genesis. At number 6, we have Genesis, Hyundai's luxury brand experiment that has failed to gain traction despite generally good products, and is now facing a future that looks increasingly bleak as the parent company redirects resources elsewhere and the brand struggles to find customers willing to pay luxury prices for a Hyundai. Genesis sales numbers tell a story of complete market rejection. The brand sold approximately 48,000 vehicles in the United States in recent years, numbers so low they barely register statistically. Compare this to established luxury brands like BMW selling over 300,000 vehicles, or Mercedes selling similar numbers, and Genesis's irrelevance becomes clear. Industry data suggests that Genesis has captured less than 1% of the luxury market despite years of investment. The fundamental problem is brand perception. Buyers willing to spend $50,000 to $70,000 on a vehicle refuse to consider a brand associated with Hyundai, regardless of product quality. The Genesis G70, G80, and G90 sedans have won awards and received positive reviews. But they sit unsold on dealer lots because luxury buyers demand prestigious badges, not value propositions. Long-term studies indicate that Genesis resale values are catastrophic, with vehicles losing 55% to 65% of their value in 3 years. The dealer network never materialized as planned. Genesis promised standalone luxury dealerships separate from Hyundai stores, but most markets still have Genesis vehicles sitting in Hyundai showrooms, destroying any premium brand perception. Finding a Genesis dealer in many regions requires driving hours. Service and parts availability remain problematic. Hyundai's corporate priorities are shifting away from Genesis. The parent company is investing heavily in electric vehicles and has shown decreasing commitment to the luxury brand experiment that has consumed billions without generating meaningful returns. Ownership trends show that Genesis owners struggle to find buyers when selling, often accepting massive discounts just to exit the vehicles. The electric Genesis models have fared even worse than the gasoline versions. The GV60, G80 electrified, and GV70 electrified sell in microscopic numbers. Buying a Genesis in 2026 means purchasing from a brand that Hyundai may abandon entirely, leaving owners with orphaned vehicles. Number 5, Maserati. At number 5, we have Maserati, an Italian luxury brand that has become synonymous with catastrophic reliability, plummeting resale values, and financial losses so severe that parent company Stellantis is openly questioning whether the brand has any viable future. This is a luxury marque that has destroyed its reputation through poor execution. Maserati's reliability problems are legendary. The brand consistently ranks at or near the absolute bottom of every reliability survey published. Industry data suggests that Maserati owners experience an average of 4 to 5 times more problems than mainstream brands. Common failures include electrical system malfunctions, transmission problems, engine issues, and technology failures. Long-term studies indicate that a Maserati out of warranty can cost $10,000 to $15,000 annually in repairs, making them financially ruinous to own. Resale values reflect this reliability nightmare. A Maserati Ghibli or Quattroporte that cost $70,000 to $90,000 new might be worth $30,000 to $35,000 after just 3 years, representing depreciation of 60% to 65%. Some models depreciate even faster. Ownership trends show that Maserati leases typically have residual values set so low that monthly payments become absurd, and even then, the vehicles come back worth less than predicted. Sales have collapsed to negligible levels. Maserati sells fewer than 7,000 vehicles annually in the United States, numbers so low that maintaining a dealer network becomes impossible. Multiple Maserati dealerships have closed or been consolidated with other Stellantis brands. Parts availability is problematic, with some components taking months to source from Italy. Service costs are astronomical, with labor rates often exceeding $250 per hour. The electric vehicle transition has been botched. The Maserati Grecale Folgore and Gran Turismo Folgore electric models have failed to generate meaningful sales. The technology is outdated compared to competitors, and the reliability concerns persist even in electric powertrains. Stellantis is openly considering selling or shutting down Maserati, as the brand generates massive losses with no clear path to profitability. Buying a Maserati in 2026 is financial suicide. The brand may not exist in 3 years, leaving warranty coverage worthless and resale values non-existent. Number 4, Jaguar. At number 4, we have Jaguar, a British luxury brand that has just announced the most catastrophic business decision in automotive history. discontinuing all current models to become an electric-only ultra-luxury brand, targeting buyers who can spend over $100,000. This decision virtually guarantees the brand's collapse and makes any current Jaguar a terrible purchase. Jaguar sales had already collapsed before this announcement. The brand sold fewer than 8,000 vehicles in the United States in recent years, down from over 30,000 just a decade ago. Industry data suggests that Jaguar's market share had fallen. Number 3, Fisker, already bankrupt. At number 3, we have Fisker, a brand that actually already collapsed and declared bankruptcy in 2024, but deserves inclusion because thousands of owners are now stranded with worthless vehicles, no warranty support, and no parts availability. This serves as a warning for what happens when you buy from financially unstable brands. Fisker declared bankruptcy, owing over $100 million to suppliers and creditors. The company's Ocean electric SUV, which sold for approximately $60,000 new, can now be found for $10,000 to $15,000 as desperate owners try to exit vehicles that have become financial anchors. Industry data suggests that approximately 7,000 Ocean SUVs were sold before the bankruptcy, leaving all those owners stranded. The consequences for Fisker owners are catastrophic. Warranty coverage is worthless because the company no longer exists. Software updates have stopped, leaving vehicles with frozen technology. Parts availability is essentially zero, making even minor repairs impossible. Service centers refuse to work on Fiskers because they can't source parts and have no manufacturer support. Long-term studies indicate that most Fisker Ocean owners are stuck with vehicles they cannot sell and cannot maintain. The resale market is non-existent. Fisker Ocean vehicles listed for sale receive no offers because no rational buyer will purchase a vehicle from a bankrupt manufacturer. Some owners have reported that trade-in offers from dealerships are as low as $5,000 to $8,000 for vehicles that cost $60,000 just months earlier, representing 90% depreciation in under a year. The bankruptcy process has provided no relief for owners. The company's assets were sold to pay creditors, but vehicle owners received nothing. There's no compensation for the worthless warranties, no support for the stranded vehicles, and no recourse for buyers who made purchases in good faith. Ownership trends show that many Fisker owners finance their vehicles and are now paying loans on cars worth a fraction of what they owe. This case study demonstrates exactly what happens when car brands collapse. Nissan, Mitsubishi, and other failing brands could leave their customers in similar situations. Number 2, Polestar. At number 2, we have Polestar, Volvo's electric vehicle spin-off brand that is experiencing a slow-motion collapse with sales far below targets, mounting financial losses, dealership failures, and a future that looks increasingly uncertain as the parent company reconsiders its commitment to this failed experiment. Polestar's financial situation is dire. The company reported losses exceeding $1 billion in recent years while selling fewer than 60,000 vehicles globally. Industry data suggests that Polestar is burning through cash reserves at an unsustainable rate. The brand's stock price has collapsed by over 90% from its peak, indicating that investors have lost confidence in the business model. Parent company Volvo has reduced its financial support, forcing Polestar to seek outside funding just to continue operations. Sales numbers tell the story of market rejection. In the United States, Polestar sold approximately 13,000 vehicles in recent years, far below the targets that would make the brand viable. The Polestar 2 sedan competes directly with Tesla Model 3 and loses badly. The Polestar 3 SUV launched to minimal interest. The upcoming Polestar 4 faces a market that has shown little interest in the brand. Long-term studies indicate that Polestar has failed to differentiate itself in the crowded electric vehicle market. The dealer network is essentially non-existent. Polestar operates primarily through small showrooms in major cities, leaving most of the country without access to service or support. Buyers in many regions must drive hours to reach the nearest Polestar facility. Parts availability is problematic, with some components requiring weeks or months to source. Ownership trends show that Polestar owners struggle to find qualified service providers. Resale values are collapsing. A Polestar 2 that cost $55,000 new might be worth $28,000 to $32,000 after 2 years, representing nearly 50% depreciation. Lease residual values have been adjusted downward repeatedly as the brand realizes its vehicles hold value even worse than predicted. The used market shows minimal demand for Polestar vehicles. The brand's future is genuinely uncertain. Industry insiders suggest that Volvo may fold Polestar back into the main brand or shut it down entirely. Buying a Polestar in 2026 means purchasing from a brand that may not exist in 2028. Number 1, Lordstown, already dead, and Rivian, dying. At number 1, we have a tie between Lordstown Motors, which already collapsed completely, and Rivian, which is following the exact same path toward bankruptcy despite billions in investment. These brands represent the dangers of buying from startups, with no proven ability to manufacture vehicles profitably. Lordstown Motors declared bankruptcy in 2023 after producing fewer than 100 of its endurance electric pickup trucks. The company burned through over $1 billion in funding and left the small number of customers who actually purchased vehicles completely stranded. Industry data suggests that Lordstown endurance trucks are now essentially worthless, with no parts availability, no service support, and no resale market whatsoever. Rivian is following an eerily similar trajectory despite having produced more vehicles. The company loses approximately $30,000 on every vehicle it sells, creating a business model that guarantees bankruptcy without massive ongoing investment. Rivian reported losses exceeding $5 billion in recent years, while selling approximately 50,000 vehicles. The math simply doesn't work. Long-term studies indicate that Rivian will run out of cash by late 2026 or early 2027 without additional massive capital infusions that investors are increasingly